Okay, it's 5 past, so I think um maybe we could start. What do you think?
Yep, happy to. I can't see how many people we've got on my screen, so I'll go
Oh,
ahead as if
look.
there's several millions of people watching, I think, and we'll see. Okay, um, so what I'm going to talk to you about today is just a couple of the ways that we can apply behavioral science in the insurance industry. Uh, and hopefully, as the kind of title suggests, really what it's about is about how people make risky decisions, either about their finances or about their lifestyle. Um, but then, obviously, how, as behavioral scientists, we can help to understand and unpick the dynamics that are at play. And in particular, so a couple of things that I'm going to talk about today. I mean, in the insurance industry, there's a whole bunch of ways that we can apply behavioral science, but I'm just going to focus on two. Um, Firstly, that's thinking about how people do or don't decide to protect their finances, and also some of the kind of promise and the challenges for using behavioral science to understand how we can use technology in trying to change risky behavior. So what I'm not going to do is I'm not going to give you a list of interventions. I mean, we do use interventions. That's a big part of what we do for the industry. But today, I'm just going to kind of discuss some of the topics we're interested in, some of the concepts that we build into our thinking, hopefully some of the unanswered questions, and I hope that I can show you that it's kind of interesting ground for behavioral scientists and give you a sense of how we try and bridge this academia industry gap in a way that I think can genuinely kind of make quite a big difference for many households. So I want to start with this quote that I think neatly encapsulates what we try to do as behavioral scientists. And the quote is, "We must design for the way people behave, not for how we would wish them to behave." It comes from a guy called Don Norman. He's a highly influential product designer. He's the author of lots of well-known design books. I think I've got one of them on my shelf over there. Um, he's the founder of an influential design agency. And in his line of work, he's probably referring to the design of the physical environment. But I think the same kind of thinking needs to apply to designing more abstract things like services and financial products as well. And I particularly like the quote because it implies, as designers, by which I'm really referring to here as anyone who's putting together some information for other people to interact with to achieve some kind of goal, that we have some kind of misplaced optimism or incomplete knowledge about how people will interact with the designs that we put in front of them, or perhaps often people haven't even thought about how they'll interact with it at all. And it seems like common sense, but I think there's plenty of examples. Um, those of you who are behavioral scientists, maybe that's all of you, will be aware of lots of the issues, but we don't save enough for our pensions. We don't buy enough insurance. We spend too much on credit cards. We don't switch energy providers or look after our health um, as much as we should do. We don't pay enough attention to risk information, as we saw with COVID and people not wearing masks as much as they should or obeying social distancing rules. So, as applied behavioral scientists, we try to change this view in real world contexts, making sure that there's a realistic view of how people will interact with the things that organizations design, and making sure that any kind of misplaced assumptions about how people will behave and interact with information are kind of challenged. And we do this by bringing insights from academic behavioral science, but as well as practical and industry knowledge and experience. And we also try and use research methods like experiments that test real life behavior. We apply data science and kind of robust statistical modeling to the work that we do, to try and make sure that it's really kind of is science, but with this practical kind of angle to it. So how do we actually apply behavioral science in industries? Well, firstly, it's about discovering what the challenges are that the industry faces and understanding whether they're really kind of behavioral in nature, and if so, what kind of behavioral challenge that is. We then look at the academic evidence to understand the issue and kind of express it in behavioral terms. We do our own primary research to understand behavioral issues specifically in industry contexts, because often the academic research comes from different contexts to the ones that we're working in. We then work with a range of other teams who have expertise in lots of different areas, so we can redesign products, processes, communications, and we test them using scientific techniques, experiments, and data science. But also a big part of what we do is we provide advice to other teams so that they can bring this kind of realistic understanding and they can ask the right questions for the kind of projects that they're doing, to make sure that the kind of this challenge, this understanding of realistic human behavior goes beyond just the behavioral science team and allows other parts of an organization to apply the same kind of thinking to the work that they do. So I work for a reinsurance company. In essence, what we do is we provide insurance for insurance companies. Effectively, we take a portion of the risk that insurance companies take. So when you buy an insurance policy, that company is taking a risk on your behavior, essentially. What we do is across the entire market, we take a portion of that risk, which helps individual insurance companies to kind of manage their own financial position. My particular company, which is Reinsurance Group of America, is one of the largest, and it's the only specialist, I think, in life and health insurance. So our job as behavioral scientists in the industry is to help understand some of its biggest issues relating to human behavior, try and influence change so that the industry can work better for its customers and become more effective and efficient itself as well. So what has behavior got to do with insurance? Well, actually, I think there are probably few industries that are so heavily reliant on understanding behavior. In particular, I think we really need to understand humans as risk takers. So behavioral scientists know that understanding how people make decisions under risk and uncertainty is a cornerstone of behavioral economics. And insurance is all about understanding how people make risky decisions. So that's why we need to bring this behavioral economic perspective to the industry. It's about understanding how people make risky financial decisions. So how do they decide whether they should protect their finances? But it's also about understanding how they make risky lifestyle decisions. Why do they drive unsafely? Why do we make unhealthy life decisions, like eating unhealthily and not doing enough exercises? Why do we not look after our property as well as we should do, and so on? Ultimately, the insurance industry stands to benefit from helping people to manage those behaviors, but of course consumers stand to benefit from managing these kind of risky decisions as well. All of these scenarios also play out over very long timescales. We make decisions today that influence our health in the future. We make decisions today that influence our finances in the future. And because of that, understanding the behavioral economics in this kind of decision making is really kind of challenging, but it's also vital for the industry and it's vital for consumers as well. So, as I said, I'm going to talk about two examples of how we do this and how insurance companies need to understand this psychology of risk taking. Firstly, in terms of that financial decision, why do people decide or not decide to buy insurance to protect themselves? And also, um, how can we use technology in particular? And what are some of the challenges in using technology to try and help people to manage risky behavior? So, firstly, we'll have a look at the behavioral science of understanding this financial decision making, which is really part of improving financial well-being for people. And I think I can provide some context here to show why this is really about financial well-being. And it's not just insurance, but behavioral scientists will know that often people don't make financial decisions uh, in a way which kind of adequately caters for their needs. So a few pieces of data on this. Over 10 million people working aged in the UK don't save regularly, and over 2 million of us have no savings at all. 60% of people in the UK don't have adequate pension savings to give them financial security in their retirement. And then when we do look at insurance, a recent survey in America showed that 52% of Americans owned life insurance. So that's only about half. 102 million of them don't have enough financial protection. And if we look at that worldwide, the kind of actuarial estimate um, suggests that there's a $12 trillion coverage gap. So what I might mean by the actuarial estimate there is on the basis of predicting when people might need insurance. So we know that a certain number of people will become ill or will die earlier than they expect. And so this is the amount of money that people are kind of leaving on the table and not protecting their finances for in those situations. And it's worth kind of mentioning that the rates of insurance have declined since the 1960s as well. So it's not necessarily an inevitability that people don't protect their finances. Context has a big role to play. And of course, the numbers kind of paint the picture, but I think it's worth really reflecting on what this actually means for households. And the same survey found that 42% of Americans say that their family would suffer financial hardship within 6 months if an earner passed away. So this is really a financial issue. It's a financial well-being issue that stands to kind of potentially put people into significant hardship if people don't protect their finances enough. And the evidence suggests that actually we don't protect our finances enough. So what does behavioral economics tell us about why this might be the case? Well, firstly, I think we can think of the thought process, or perhaps the lack of the thought process, as an ostrich effect. So we know that people react to information not just based on its instrumental utility, so that's how useful it is for actually improving our decisions, but also based on how it makes us feel. So we might ignore information that makes us feel bad, even if it's useful. And to consider buying life insurance, you have to think about the prospect of your own death. You have to think about what would happen to your family in that situation. You have to think through an unfamiliar and often complex financial purchase, which has difficult terminology and financial trade-offs. And none of these scenarios are particularly rewarding or pleasant things to think about. So we bury our heads in the sand like ostriches, avoiding the information, avoiding the decision, even when it could be extremely useful for us to engage with it. As well as avoiding information because it's challenging emotionally or cognitively, making these kind of decisions also has this um, long-term aspect to it. So we have to contend with the present bias or hyperbolic discounting. If you think about what it means to buy insurance to protect your finances from these unexpected things that can happen. We have to pay a premium for something now that will hopefully not actually need to pay out for a long time in the future. And it's not even you that gets the payout in the case of life insurance. So it's kind of the opposite of a buy now, pay later kind of deal that gets kind of thrust onto us by marketing people all the time. Behavioral economics shows that we overweigh these immediate or near future rewards and punishments, and we underweigh things that happen to us in the future. So it makes this kind of long-term financial decision making particularly difficult for people. And the final challenge that I want to mention today is the kind of lack of salience of making these kind of decisions. It's kind of related to avoiding information and also to present bias, really, because often making these kind of financial decisions just isn't a priority for us. Because the consequences are so far in the future, making that decision right now simply isn't top of mind for us most of the time. This is also, I think, particularly a challenge online, where we ingest such a huge quantity of information that's all trying to grab our attention. It's unlikely that making this decision that involves thinking about your own death and thinking about insurance, it's unlikely that that is going to win compared to choosing a new pair of trainers or liking a cat video or something. It just doesn't pop out to us. It doesn't kind of grab our attention and force us to make the decision. There are some behavioral economic factors, though, that can influence why sometimes we do make these kind of decisions. So an interesting study, I think, shows that people are more likely to buy flood insurance when they hear about widely reported floods. And it's even the case if they live in unaffected or not at risk areas. So what's interesting about this is that a flood in another area doesn't objectively increase your own risk of being involved in one at all. They're unrelated events. But it does bring that risk to the top of your mind. And psychology research shows us that when an event is easy to imagine, we also believe it to be more likely. So we might be more scared of terrorist attacks or shark attacks than we should be, because they're very emotive, they're very widely reported, they easily spring to mind. Whereas we might be less worried about road accidents than we should be, because they're less likely to be reported, they're less prevalent in our minds. So these kind of dynamics are at play. Where the industry thinks about risk very objectively, we need to understand humans emotionally, and we need to understand humans in terms of how they actually process this kind of information and make decisions about it in a realistic way. And actually, some of our own research shows similar things. So we do often big experiments or big surveys. The chart you can see on the screen at the moment is from a survey of around 3,000 people, which was looking at a number of different things. But one of the things that you can see here is the proportion of people in our sample who had who owned life insurance or had recently made changes to their life insurance, split by different kind of demographic segments, or in fact, life event segments. So what you can see is that people who had young children or were in the process or had recently bought a new house were more likely to buy insurance, or were more likely to have recently made decisions about their insurance, which isn't really surprising because both of those scenarios kind of create a new risk for you to manage. But what we did find was that people who had recently been bereaved or knew someone who had been bereaved were also more likely to buy insurance. So nobody is suggesting that insurance companies should target people who have been bereaved, but from a psychological perspective, what is kind of interesting here is that nothing about being bereaved changes your own level of risk. And by the way, this was controlling for things like age and so on, which could affect that. Um, Nothing about being bereaved changes your own level of risk, but what it does is it brings it to the top of mind. So we need to understand how context affects how we think about risk, rather than objective things that influence our level of risk in terms of how people make the decisions. We also found that the same pattern was true when we looked at people's attitudes to life insurance. So people who had young children, or had recently bought a property, or had recently been bereaved, were all more favourable to the idea of insurance than those who weren't. So one thing we were also interested in was whether not only these kind of life events that are happening in the background influence people's kind of perception of insurance, favorability to it, but also the immediate context that they're in. So if you imagine when you're kind of scrolling through social media, is that a context that makes you think about insurance compared to perhaps going in to make some kind of transaction with your bank or something? Do we need to be in the right frame of mind to make these decisions? So again, we had about 3,000 people. We used a randomized control trial type experiment where we primed people with different types of information by showing them different kind of fictional products or pieces of information and asking them some questions about it to make sure that they really kind of engaged with it. And we used a control group where we didn't prime them with any specific information. We also used what we thought of as an irrelevant kind of prime, where people just looked at some social media posts. And then we looked at a range of things which either relate to risk or bring it to the top of people's minds, like making decisions about a mortgage, donating to bereavement charities, reading health information, or buying products to do with parenting. And then we tested their implicit and explicit attitudes to insurance. And the way we did that was by asking attitudinal questions and measuring people's reaction times as well as their actual answers to the questions. So there's some evidence that reaction time is kind of suggestive of how strongly you hold a particular belief. So if you're able to answer very quickly, it suggests that you're quite sure that you believe that answer, whereas if you ponder, it suggests that you're not sure. So our results, to be honest, were kind of largely inconclusive, and I think this is probably because it's difficult to generate these kind of priming effects in a laboratory where the information is less kind of real than it is in real life. But we did find some kind of suggestions where people had been in that context before. So the simulation to them was stronger. We found that some of those immediate contexts were more likely to produce stronger attitudes, stronger favorable attitudes than the control groups and irrelevant groups. We had put people into the context, but before we asked them about their attitudes, so this is before they knew this was an insurance study, we asked them to give us a list of financial services that were relevant to them. And only 6% of people mentioned life insurance. And then when we gave them a list of financial services and asked them which were relevant, 34% of people said insurance was relevant. So here this shows us that even when we put people in these contexts that bring risk to top of mind, they still need to be reminded that these kind of products are relevant for them. They're just not things that people go around thinking about day to day. We also know in behavioural science that who delivers a message can be just as important as the message itself. And I think this is a really important concept for us if we want to engage people with good financial decision making. in order to convey these kind of messages that people pay attention to, engage with, and actually think about financial decisions, we need to understand the role of who is giving the message to different groups of people. We know there are predictable aspects of messengers that are important for how effective a message is, such as how likable, authoritative, and similar a messenger is to a recipient. But exactly how this plays out in financial decision making is kind of unclear. It's an area that I think behavioral scientists will need to explore if we want to help promote financial well-being. So behavioral economics tells us that context is important. It tells us that messengers are important. But another area that's important is people's actual understanding of the information when they do engage with it. So one thing that we've done recently is we ran a large project in collaboration with an insurance company where we applied lots of behavioral science principles to improve letters that they were sending to their customers. And we used a range of techniques from behavioral science to improve the comprehensibility of those letters. And then we ran a randomized control trial and we tested comprehension using a kind of multiple choice test, which had objectively right or wrong answers. And what we found was that the behaviorally enhanced versions significantly improved how well people understood the communications. We also found that there were differences when we looked at dynamics such as financial literacy, which demonstrates that we really kind of need to think about how different groups of people will kind of react in different ways to interventions and react in different ways to information that they see. I think this is a great example of how we can use behavioral science to both understand and improve financial well-being and also financial inclusion. You know, we're talking about making this accessible to groups of people who are sometimes left behind. We want people to make informed decisions. Comprehension of financial information has to be a big part of that. So just to summarize, I think we've seen that several biases influence people's decision making around financial products and how to protect themselves. This potentially can cause households significant hardship if they don't make the right decisions. I think the behavioral science shows that context is important in how we help people to make those decisions, help them to engage with the decision, as well as thinking about the right messenger, and also using kind of persuasive techniques to get people to engage with the information. Ultimately, we want people to make informed decisions. So we need to understand how we can make financial information more comprehensible. And I think these are some of the ways that behavioral scientists can help people to make these informed decisions to improve financial well-being and financial inclusion. And the insurance industry certainly has a big role to play in that. So I want to move on and talk about lifestyle as well. So this is a separate part of risk in terms of risky kind of lifestyle behaviors instead. And in particular, focusing on the role of technology and how it can promote behavior change, but also some of the challenges there in using the technology that behavioral scientists are the best place to think about. And ultimately, again, this is an area where both the insurance company stands to benefit from people behaving in less risky ways, but also consumers stand to benefit as well. So ultimately, it's a great area for behavioral scientists to be thinking about. I think technology is a promising means for changing behavior. Specifically, I think about the Internet of Things. So this has increased our ability to collect real-time data about a really wide range of behaviors and to feed that data back to users of the technology, the consumers ultimately. So the Internet of Things is made up of smart devices that have sensors and software. They connect to the internet, they connect to other devices, and they connect to us as humans as well. These are things like smart electricity meters, smart watches, telematics devices in cars that monitor driving behavior, and so on. There are really quite a lot of applications for the Internet of Things now. The real power of the technology is that it collects huge amounts of data about behavior that were previously inaccessible. For example, smartwatches now count steps, heart rate, sleep patterns, and a whole range of other health behavioral data. Similarly, telematics in cars can tell whether you're speeding. It can tell you if you're cornering too fast. It can tell you if you're driving at dangerous times, and so on and so on. The devices usually have an interface, so you can replay the data back to customers, which should be useful for enabling behavior change techniques. When we think about this in a health context, it's clear that there's potential value for consumers in the technology. It's well documented that our major health challenges in this day and age are really associated with lifestyle and behaviors. So smoking, excessive drinking, unhealthy eating, low physical activity are associated with major diseases such as cancer, diabetes, heart disease, depression, and the list goes on. Wearables have this potential to give us a unique and objective insight into how our lifestyle is putting us at risk of these kind of things. And these devices have the potential, obviously, to offer us the tools to manage that kind of lifestyle as well. So there's undeniable potential for the technology for consumers. But I think as behavioral scientists, we know that changing behavior is not that easy. Rarely is it kind of ever that easy. The technology can facilitate behavior change, but it doesn't change the behavior in itself, perhaps with the exception of the Hawthorne effect, where we know if you're being monitored, it can change your behavior. But one reason is that people who give us this technology kind of assume that we share the goal of using the technology to change this range of behaviors. And even when we do have these virtuous kind of goals, it doesn't necessarily translate into virtuous behavior. And expecting customers, users to embrace and act on health goals, I think, is kind of an incomplete understanding of how people will actually behave around this technology. Some of the statistics around this, I think, demonstrate it. Estimates vary, but largely tell the picture that download rates of health apps are lower than we would like them to be, despite the market being full of options. We've also seen data that suggests that few users actually continue to use these kind of apps for longer than 7 days, and many of them are never even launched. While the market for wearables has grown steadily over the past few years, the data suggests that many people actually stop using their devices fairly early on. There's also a number of scientific reviews that kind of show shaky evidence really for the potential of these kind of apps that are available to change health behavior. And a lot of that is because of the low engagement rates. So I think the data tell us that there are really three challenges for behavioral scientists to think about in terms of technology for behavior change, and that's actually adoption of the technology in the first place, ongoing engagement with the technology, and changing behavior in the long term as well. Part of the challenge is understanding the goals that really motivate our behavior. If we're going to attempt to promote adoption and engagement with the technology, and you might ask, well, is focusing on health not the right goal? But I think perhaps kind of symptomatic of this engagement problem is people's short-termism when it comes to thinking about goals. So the graph on the screen shows worldwide Google searches over the past 5 years for the term fitness app. So there's I think a steady kind of upwards trend, which is encouraging. But I think the obvious feature is the kind of drastic peaks and troughs um, in the graph. So, as you probably guessed, these happen around New Year when people are thinking about their health goals. There is an additional peak there as well, which coincides with the beginning of the COVID lockdowns in 2020. I think really this certainly tells us that our health goals are powerful in certain contexts, but far consistent in influencing our behavior. And I think when we think about this in the context of the short lifespan of engagement with the technology, it really gives us this reflection of people's short-termism when we think about our health goals. Often we believe that we're going to use the technology to help us get healthy, but it just doesn't play out. And I think this is one way that behavioral scientists need to inject this realistic interpretation of behavior into these kind of situations where otherwise product designers might see more potential in the technology um, without understanding these kind of gaps. So one example of understanding the goals that really kind of motivate comes from this large NHS study which tested uh, different messages aiming to promote engagement with an alcohol intake reduction campaign. And one set of messages focused on the role of reducing alcohol intake on long-term health. So it reduces your risk of breast and bowel cancer and liver disease and so on. And the other set of messages focused on the role of reducing alcohol consumption on your appearance, so saggy skin, obesity, premature aging. And as you might have guessed, the second set of messages performed better in terms of engaging people. Really, I wanted to use this as an example of how people's goals, to the extent that they motivate our behavior, can be surprising. And behavioral scientists are needed to figure out how we tap in to those motivations if we really want to get the behavior change effects that we're looking for. The insurance industry typically does this with financial incentives. So, for example, young drivers with telematics get given discounts and rewards based on how well they drive. So, whilst driving safely to avoid accidents, serious injuries, and even death should be up there with the top kind of list of what motivates us, actually being incentivized to do it financially can be more powerful than that motivation. Similarly, with health, um, insurance companies now offer incentives for behaving healthily. And there's even examples of this with pets where people are incentivized to kind of walk their pets the right amount to keep them healthy. So do incentives work? Well, actually, yes, there's evidence that they can be effective for promoting engagement. And in my experience of working with these type of products, the incentives definitely help to engage customers. But of course, it's not that simple. It never is. We know things like the framing of the incentive are important, whether we frame it as a loss or a gain. Um, kind of an example of this is the Vitality program, which gives customers a discounted Apple Watch, which you have to pay more for if you don't hit physical activity targets. We know that communication of the incentive is kind of really where the power is. How do you give people kind of evidence that they're making progress towards earning a reward or a discount? Do you give them points? How do you give them points? How do you give them a range of different benchmarks to keep them motivated and so on? There are a lot of different questions here for behavioral scientists, but the key point is that the way they're positioned, the way they're framed can be really powerful. And by turning to academic evidence, but thinking about creative ways to use incentives, and then also to um, test their effects in the real world, is one way that behavioral scientists can really have an impact. Another technique that's commonly used is gamification. So by that, I mean using elements of the kind of things that you would find in video games to motivate customers either to engage with an app or to change their behavior. So examples are things like getting badges and points and so on. But often apps will even introduce narrative and kind of fun elements. There's one called Zombies Run, which, as the name suggests, kind of puts you through a video game scenario in which you have to run in real life to escape from zombies, which is kind of fun. So there is evidence that this kind of gamification can be powerful for engaging people, but there's also a risk. It can be superficial, mistaking kind of surface level tactics for deeper psychological or behavior change strategies. For example, achievement badges might work in a kind of video game scenario which rewards you for progressing through a game, but when you're trying to change a more complex behavior like changing people's physical activities habits, it might well kind of miss the mark. And there's a danger that if the realistic understanding of behavior is not injected into this kind of design, then people lift and shift these kind of ideas and expect them to work, and they just miss the mark. So we work with insurers to make sure that there's an evidence base to the ways they try and change behavior, ensuring that there's recognized behavior change techniques. But we also develop tools so that the industry can kind of use the recognized science of behavior change to embed this understanding of behavior into its products as well. The final challenge I want to call out for behavioral scientists is unpicking self-selection effects from behavior change effects. Now, of course, how we typically do this in laboratory settings is with randomized control trials where you can test whether a particular intervention is effective at changing people's behavior. And of course, you can even do that in the field, although it is more difficult for practical reasons to run randomized control trials. But the key issue is that once a product is released into the market, it no longer behaves like a randomized control trial. So once a product is released, anyone can go and pick it up rather than randomly assigning people to use it. And there's evidence that these kind of behavior change products are more likely to be picked up by those who have latent interests in changing their behavior. So, for example, this recent study found that people with a risk of or who actually have cardiovascular disease were less likely to use wearable technology for managing their health than healthy individuals in their study were. So we have to acknowledge that outside of the laboratory, those who might benefit most from this kind of technology might be the people who actually need it least. It's a really tricky problem for behavioral scientists to unpick, and it's highly related to the engagement problem. How do you engage the right people with the technology when it's easiest to engage people who are already motivated to use it? But we need to understand this dynamic in order to really kind of understand the role of technology in the real world in changing people's behavior. So that's more or less all from me. I just wanted to return to Don Norman's quote here that we have to design for the way people behave, not how we wish them to behave. I hope that I've shown that this quote rings true for how people make financial and lifestyle decisions, and how companies often have kind of misplaced assumptions about how people will interact with their products. And I hope I've given a flavour of some of the concepts we think about relating to two industry topics that are related to risk. So how do people make financial trade-offs, and how technology can motivate behaviour change, and the issues where behavioural science can really have an impact there. I think in doing so, the insurance industry is really kind of well placed to produce better outcomes for households, to help them manage these risks, but really it needs this realistic understanding of human behavior to be injected into it. Behavioral scientists combining academic expertise with the practical solutions, scientific testing and analysis, is really what's needed to help the industry to achieve its purpose of helping people to manage the risks that they face in their lives. So thank you very much for listening. That's all from me today. Happy to take any questions if you have any.
Thank you, Peter. That was really, really interesting. Even as a behavioral scientist, you give me lots of ideas and thoughts. So thank you for that.